Yeah, hey Jake, what's up? So I saw your thing and I had a spontaneous thing. I said I'm just going to do one now. So glad you guys showed up. I gave it a few minutes. Yeah, go ahead, say whatever you want to say. Excited about this company. I used to do these like every week. Me and a couple people in the community would do these every week back like maybe a year ago, 6 months ago. So it'd be great to start them again. So yeah, introduce yourself and go have at it.
Hey, yeah, no, it's great to meet you, Christian. Um, I'm happy to, yeah, happy to get the conversation rolling and talk about lemonade. I think about lemonade all day, every day, so might as well talk about lemonade a bit, right?
Yeah, that's
um,
kind of how we started. Like we were like this company, like I followed it from the beginning. I don't know if you ever joined or listened to any of the old spaces we used to do. How this company started, how it rocketed. Because I was kind of in there, kind of not knowing what was going on. It got all the way to like 160 from like 60 from the IPO, and then it kind of crashed down, got all the way to 10, and we see
yeah,
how the stock is just not doing much, and it was going down as the fundamentals keep getting better and better and better, and how different this company was from 2020 when it was basically just a renter's company, and now it's got the pet line, it's got the lifeline, which I'm a super bull on lifeline. All these young people getting life insurance, so that's such easy money for them, and I think they're growing it if you look at their appendix and their thing, but like that's a great business. Car right now is going to be the game changer. If you look at their car premiums, 1880, I think on average is what they're getting for that
mhm,
line. So like this company's completely been transformed. We always love the management. We've gone into like Shai's a genius on the tech side, and you got I think Daniel Schreiber is probably the most eloquent and CEO I've seen in a long time. So it's
mhm.
a top-notch management team. And they always deliver on their promises. They don't hype everything up, but they say they deliver what they're going to say, and they deliver on it. So I've been completely impressed. I love all the way everything is laid out. Beautiful design. Like the company is just a beautiful company. If you look at all their literature, all their videos, very funny, always well done. Their investor days are world class. Probably the best two investor days I've ever seen in my life were by Lemonade. I rewatch them over and over to keep my conviction high. I just keep rewatching the second one and the first one, more the second one now because it's more recent. But again, another great presentation. So I'm like so bullish, but it seems like the market, whether it be insurance or it's not profitable yet, and just can't wrap their heads around anything yet. And I think the stock's getting hit today, just personally, is because of all this autonomy, and they think, oh my God, every car is going to be autonomous. We're not going to need insurance, and that's so
Mhm.
silly, right? But that's an opportunity for us to collect shares because there's like what billions of cars in the world, and
Mhm.
we're talking
Mhm.
like they might be a few million that's autonomous. So it's like you have so, and this company's such a small base, and
Yeah,
it has so much to grow in. I'm kind of rambling. I'll let you go further on it, but I mean, talk more about the business and the opportunity at a 2 billion market cap. What this company is going after, like the biggest industry in the world is insurance, is just incredible.
yeah, no, for sure. I agree. I agree with every single thing that you just said. And then the other thing is to keep in mind, like beyond the fact that we love Daniel, we love the CEO, we love their literature. Like I think their roadmap, their execution, the fact that they've just beat every single guidance that they've ever given us, like all of that is really exciting. But the other thing is that all of the short arguments are just dying. Like they're just slowly dying one at a time, and it seems like those that are negative on Lemonade are putting like some blinders on right now, kind of ignoring the last few quarters. Like I'm still seeing bears come on and say like, Lemonade's not free cash flow positive. Well, it's like, okay, well, they were free cash flow positive on an adjusted basis overall last year. But then I think Q4 they were free cash flow positive on any basis, no matter which way that you look at it. So it seems like the bears, those who are negative on the company, just are ignoring the most recent reports, ignoring how the narrative is shifting, and ignoring the fact that Lemonade, it's transitioning from a company with a super massive like fixed expense set that was honestly very large for the amount of policies that they had, to the expenses staying the same and the policy count, the revenue just growing and growing and growing on this like fixed expense space. And I don't understand how, when you're looking at this and you're looking at the trajectories, you don't see the same thing that management is telling us, which is that we're about to transition into a massive cash flow printing era for Lemonade, where all of a sudden all of these new policies start dropping far more to the bottom line. And I just think that this change, I know that like for a fact, it blindsided Tesla shorts back in 2019, 2020, and it's about to blindside Lemonade shorts as well. So they can enjoy the 6% down day with over 50% short volume pushing it down. Sure, let them get this little victory, enjoy the sale prices, buy up the company on these like down days, and pay attention to the fundamentals, because as long as the fundamentals keep trending in the right direction, and there's no reason that they should not, guess who's going to get the last laugh? It's not going to be the shorts. It's not going to be the shorts. So I don't know. Do you have any thoughts on any of that?
Yeah, no, 100%. I think you said it well. I think like this company's a hard company for some people to understand in this sense. And you could probably speak to this. The way the company's working, it's there, it's coming, the profits come after the initial investment. So normally when they put out the money now, and this is why synthetic agents, I think this is important. Synthetic agents allows them to do the 5-for-1 rather than to put their own capital and wait for the, a couple years. And the beautiful thing about synthetic agents is once synthetic agents gets paid back, which is about roughly just over 2 years, it looks like from what I see, 2 to 3 years, all that revenue goes to Lemonade. All that premium goes to Lemonade, and it stops with General Catalyst. The synthetic agents no longer get it. So when you look, it's really, this investment has to really be a long-term investment for you, where you're like in this for like the next 2, 3, 4, 5 years for all this to play out, and probably even longer. Maybe, this is one of these like Buffett Geico things, maybe like forever, because once all that starts hitting, it's just going to be an avalanche. And like you said, 30% short. I think even this quarter, I think I keep looking at the Google Trends, and it looks like they are pushing Lemonade Car out very aggressively. And they added Colorado, which was great. So I see them, one of these quarters, whether it's next quarter or the quarter after, you're going to see a big pop in the premium per customer. And I think a lot of investors and traders or whoever is going to say, whoa, they've been growing premium per customer, but it's kind of slow, 4 or 5%. They're going to see that car explosion, because if you remember from last quarter's report, car was outpacing the rest of the lines. If you remember in the report, they said that, which is very important, because when car starts to outpace, these premium per customers are going to start to explode over the next year. And you're going to see, I do a quick valuation, just very simple. Number of customers times premium per customer. We have 2.5 million. When that goes to 3 million, and right now we have, I think, like 400 premium per customer or something. Once that goes to 500, 600, that's the doubling of the business. And remember, in Investor 2, the doubling of the business does not lead to a double in adjusted free cash flow. It leads to a 20x in adjusted free cash flow, which is, again, those financial metrics are going to explode and only get better as the synthetic agents roll off over the next couple of years. And all this upfront investment then shows up on the backside. So that's what I'm super excited about.
Yeah, for sure. I don't think people understand the dynamics of what happens when your revenue is growing and your expenses aren't. How much of that additional revenue just explodes, like you said, 20xing profitability. So I'm really curious to see, because I've seen this happen, multiple times before. What happens to a highly shorted small cap stock when all of a sudden the narrative shifts from money losing, book value dropping, potential for bankruptcy, to wait, they're EBITDA profitable now? Wait, they're headed for net profit and their free cash flow is exploding every single quarter. Like when that narrative shift happens, when the market finally realizes that they're betting the wrong way, like you're just going to see these insane runs that I just don't think people are ready for. And that's why I think that, like, you know, these small down days like today, just enjoy them, try to buy a couple more shares, because that overall long-term story is just absolutely narrative shattering. And then I think that, you know, like we haven't even seen that much AI hype. Like maybe there was a little bit of AI hype around Lemonade back in 2020, 2021, shortly after the IPO. But recently, I don't think any of the like super excited AI investors that are thinking about efficiency gains and productivity gains, and the fact that, you know, we might have unicorns with a single employee because of AI, none of them, for some reason, Lemonade is on the radar of none of them, which is just really, really interesting to me. And I think the fact that people look at Lemonade right now and they see it as an insurance company rather than an AI company, is just opportunity. Like that is just clear opportunity for anyone who's willing to look a little bit deeper. Like if you just look one layer deeper, you realize that this is potentially one of the most revolutionary AI companies in existence today. And all the new startups that have been popping up since 2020, since ChatGPT made AI popular, it's like they all started 5 years behind Lemonade, which started AI first in, you know, 2015. So Lemonade has just been at this with this sort of just belief in AI before anyone else. That the fact that like the whole market has now joined them, and now the market is ignoring Lemonade as an AI play at all, when Lemonade was here and the market wasn't even thinking about AI. I just think that it is absolutely hilarious. A high form of what's the word?
I hear you. No, I totally get it.
Yeah,
Like, Tesla, Lemonade was the ultimate AI play in 2015. If you remember, they show you in the banner, they're talking about artificial intelligence. And the thing I love about Lemonade is because, like, you have Root, and I've done some work on them, but they're just monoline, right? They're car. You have some that are just like home. You have some that were like this is the full suite. This is, and that's the other thing, which they just has barely, I think they're at 4 or 5%, the crossover. And that's where car, I think, is big. Because this is important, out of the 2.5 million customers they have, management has cited there's about 700,000 waiting list. And their initial strategy was to go after their existing book of business, which would be no incremental CAC to them. So you literally have a pet customer or a renter, they have their car, you didn't have it in their state, and now it's available. Now they just pick them off. They know they're a good customer, they pay their premiums and everything, and now you grab them for no extra cost. So this is going to be the initial rollout. That's why I'm so excited. I'm really excited for this next quarter, because I think we're going to see even a little bit more. We got the wildfire out of the way. That was holding the stock up a little bit. But I think the market just needs to see the numbers. And once they see the numbers, this quarter, Q3 is always their best quarter. So that's coming up. That's going to be another great quarter, I think, you know, barring any crazy natural disaster to get in the way of things. But I think they've managed well. They have a track record now getting through the California fires. They had a track record with the Texas freeze. They got through that. So they were able to manage all the claims from not having any agent, doing all that perfectly. So I think this company's battle tested. I think they're in a great position. I think Shai and Daniel and all the team are locked and ready to build this thing for the long term. And I'm just really excited about it. And I know you are. And there's a big Lemonade community. So if everybody's in here, like, there's a Lemonade community. I think we're up to 2,400 members. So come in, join, welcome to, for nice chat, keep it clean and everything. But we like to, I like bear cases. Like I said, give me the bear case, because the bear case is like book value. Go look at Progressive. I go look at these other companies, Progressive, they have like 4 times book value, 5 times book value. Lemonade's book value is like 3 or 4 times. Like this is ridiculous. This is a growth company and a tech company that doesn't use agents. They use artificial intelligence to do all their claims. They don't have commissions into perpetuity. Everything, is completely different, other than, yes, they're in the insurance business, but they're literally remapping the insurance business from a base of 2 billion. So this is just like one of these incredible opportunities that, like, when the stock is like at 60 or 70, you're like, oh man, I wish I bought at 30 or 29, or back in the day when we got it for 18, it was like flatline from 16 to 18 for like a year. So like these are the times, if you're a real investor, to really dig down, go research the company, find out for yourself and make a determination. But yeah, until I'm proven wrong or until the metrics start coming in a different way, Lemonade story's right on track.
Yeah, and I think a lot of people underestimate like how big of an opportunity insurance really is. Like it is 8% of US GDP. It is one of the largest industries in the entire world. And Lemonade is set up after fundamentally rethinking how insurance should work by aligning incentives and by having like trying to make it a fully autonomous organization. They are rethinking, like you said, from a $2 billion base, a multi-trillion-dollar industry. And what that means is that like look at Tesla, for example. If you look at Tesla's obviously super, super big. It's worth over $1 trillion now. But compared to the incumbent automakers, the incumbent insurance players are much bigger than the incumbent auto players. So if you get an innovative company, like a Tesla innovating, disrupting automotive in insurance, insurance is a way better industry to be in than car. Like it's not cyclical. It doesn't rely entirely on interest rates. You don't go through these big booms and big busts. The industry itself is way larger than auto. And yeah, it's just like you hit the size of Progressive and all of a sudden you 100x. Like Progressive is almost a $200 billion company. Lemonade's a $2 billion company. Progressive has like 10% of the auto market or something. So you don't even need that big of a market share. But then imagine Progressive has like almost 20% expense ratios. Imagine automating that. Progressive just announced they're hiring like 10 or 20,000 more employees to continue expanding because they need human intelligence for every single intelligent task at their company. You have a Lemonade that's twice as efficient with just the same, slightly over 10% market share, and you have a $500 billion company. Like that is insane for someone that for a company that has the potential to take way more than 10%. Plus, Progressive is only auto, right? So Lemonade is also multi-line. So it's going to be it has all of these other products on top of automotive as well. Progressive is also only a US company. So they only offer policies to US automotive owners. So you already have Lemonade. Guess what? It's an international company. It already is growing in Europe. So you have a company that has the potential, if it only disrupted auto and became twice as efficient as Progressive and had a small market share, would become a $500 billion company. But that is one product, such a small portion of the total TAM that they're pursuing, that I just, when I actually run long-term numbers and think about if Lemonade had a 15% market share in some of these products that they're in and were slightly more efficient, like we're talking about a multiple $trillion company, which like this is the sort of investment. Obviously, this would require a ton of execution, right? They have to execute. They have to continue doing an incredible knockout job as they have been doing. But if they're able to do that, you're talking about the sort of generational company that doesn't only change your life, it changes like multiple generations after your life as well. If you want to set it up that way. So I just think the opportunity here is super, super large. And then on top of that, the other thing you have to think about is, maybe you don't have to. I think if you only focus on the Lemonade fundamental case, you'll be fine. But if you broaden out a little bit and think about the fact that small caps have been pretty much flat since December 2020. This is one of the longest periods of underperformance for the Russell 2000 compared to the S&P 500 on record. And the fact that after previous prolonged periods of underperformance, there's a mean reversion and you get years of outperformance from small cap stocks. Like if history is any guide, like small caps, you just have this like incredible company that's also happens to be caught up in like a macro environment that adds to the opportunity. And I just think that you're really getting it. Like you're not going to see opportunities like this very often. Like maybe once every decade you'll see an opportunity like this. Like that's really how I feel right now.
Yeah, no, I think you said it super well. Like it is staggering to think of. I don't even go there sometimes to think trillions. I just think of it like, okay, like can this be like, a 20 billion or a 50 billion dollar? I agree with you. It has the potential, but like, I'm just like, okay, in the next 5 years, could this be a 20 billion, a 10x? And I'm like, easily. It's like easily, like
Yeah.
what they're going after and how they're doing it, the scale, of keeping that head count flat, right? And those we see those great charts where they're going to be the most efficient, like 4 million, I think, per head or something. I don't know what exactly it was,
Yeah,
but
yeah, yeah, yeah.
yeah.
Like
So
they'll
it's
be more
just
efficient than Spotify, more
yeah,
efficient
yeah,
than
yeah.
Netflix. Like,
And I think a billion, they were like in the company of Tesla, Spot Baby, like the first to reach a billion, like very quickly. Remember, this is a young company, started really getting going in 2016. Originally formed in 2015, but I think their first sale was in 2016. Like this is like a really young company. They've come a really long way in a short amount of time. So I just think it's underlooked. I think people, I don't know. This is like one of these stocks where retail should be like in love with this stock. It has the give back program. They're not your typical insurance company trying to screw you out of every little dollar. They're very forward
mhm.
looking when it comes to, you know, new ways of doing things. And if I were getting insurance and I was like 25, 30, I would just want to go to the app and take care of it. I don't want to deal with faxes, and I don't want to deal with sitting at a table with some, agent, and we're like filling out forms for like 2 hours, which I've done before. It's just crazy.
Yeah, no, for sure. It's like insurance is like there's no way I think that you could even argue that's not one of the most disruptable industries in existence today. It's just sitting there waiting to be disrupted with multiple like over 100-year-old companies that currently have most of the market share. Like these things were created long before computers ever existed, and now you think in the age of AI that they're going to be the winners. It's just absolutely crazy. Should we let this person maybe ask a
Yeah, yeah.
question? I
If
see
you see anybody, you could do. And while you're doing that, I don't know if I look at like the top. I did a post, the top biggest insurance companies by market cap, and there's a website that does these beautiful. Like you could do auto. I did insurance. Lemonade was 163, 163 at two. Just over 2 billion. Imagine the entire. I don't know if you know, Jake, off the top of your head, or if you could look at what is the total insurance market cap. It's got to be like incredible size. Imagine if Lemonade could get like 5% of that or 10% of that, or like even like a couple. Like it's crazy what they can be over the next 5-10 years. It's just staggering.
Yeah, yeah, no, it's multiple trillions of market cap for insurance companies. Kartik, I made you a speaker. Did you have a question or comment that you wanted to make there? You can unmute yourself.
So by going through call, it seems like they will be debt profitable in 2027, at the end of 2027. Is that expectation? Do you guys believe, or you think it may take more time, or it may come early?
Yeah, so I think if you look at management's previous predictions like this, they do tend to hit it early. So I think probably one of the biggest examples is that they were projecting in 2022 that they would become cash flow positive by 2025. But they actually hit it a year early, and were free cash flow positive in 2024. So I think that the likelihood is that they do hit it early. And then you have to remember that even though they are predicting gap profitability in 2027, that they're going to be EBITDA profitable before that. And I think the market is not going to wait until they're gap profitable before the stock starts getting bid up. But I mean, obviously that's just speculation. Does that answer your question?
Yeah.
Okay, thank you.
Oh, yeah. I think that's right, Jake. They were a year ahead on because now they're cash positive, and that's another thing that just hit me. Now that they're cash positive, net cash, right? Except for last quarter because they had the fires, but they've been net cash. That just gives them more opportunity to now invest, right? If they're building their cash balance now along with synthetic agents, it just keeps that fly loop going, and everything just starts ramping up. Because I think Daniel always says, in order to get really profitable, you have to scale up. So I think there was a bit of time where they weren't scaling up. Their growth had slowed because they wanted to make sure that they had everything buttoned down. They're really working on car. If you remember what Daniel said, and in Shy, car has the most work. The most people are working on car. This is the product. This is the inflection point for them. So this is like the next year is a big year for Lemonade. So like I think this is it. Like this next year. It doesn't mean like if they don't hit everything, but like over the next year, we need to see big improvements. Because as much as I'm a bull, I'm always critical of companies I own. I want to see over the next year them really ramp that car, and I need to see the premium per customer go up. And that's the key metric. Can they get that premium per customer to come up? Because if they can't, that's the problem. But I think with car, go look at the appendix. 18, I think it's 1880 is the average yearly for their car customer. So imagine, they got 700,000 in waiting. Do 700,000 times 1,800. I mean, that's like doubling the business right there. It's just crazy numbers.
Yeah, yeah. I think there's a good chance that we don't get a lot of those waitlist customers, but there's a good chance we do get a lot of them as well. And even if you got a small percentage of them, like that's very high premium customers with almost no cost of acquisition. And even if you got a third of them, that would drastically change how people viewed Lemonade. And then the other thing to think about is like, I have actually no fear that Lemonade's average premium per customer is going to rise, because what did they start scaling first? I mean, they've been scaling pet insurance and renters insurance. Like they've been dominating these low premium policies. Why? Well, because they can actually handle those customers' requests much cheaper on a per policy basis because of automation. So they're actually able to be profitable with much lower premium policies, whereas Legacy just can't, because like if you're paying $50 for insurance on your phone and you call once, it's like that the cost of like talking to that person, and then if they have to talk to another person, is like already in salaries you're unprofitable and you haven't even paid out the claim yet. So Lemonade with AI is just going to be able to greatly expand the number of products that can even be insured in the first place. But yeah, so that's why they've been targeting super low premium policies, and it's just going to be really easy for them as they start to scale higher premium policies for that average premium per customer to continue rising. And then the other thing to keep in mind as well that I am going to be paying attention to is that loss ratio on car, but it's been coming down pretty solidly. I have no fears that they are going to be able to keep bringing the loss ratio on car down. Why? Well, because they've already brought successfully the loss ratio down on multiple other products that were following the exact same trend that they predicted beforehand. Hey, this is going to keep going. We're going to hit our target. And wow, look, it happened. So on car, it's like, you've done it 3 times before. Are you going to be able to do it a 4th time? Probably, especially when with car telematics, they have far more of an advantage in their ability to price accurately in car than I think they even do in pet or renters insurance compared to incumbents. So they have this massive advantage, and they've already done it 3 times. So I really think that, like, I'm not actually that skeptical that they're going to be able to keep bringing loss ratios down and scale that out. And then one last thing I want to say here before I toss it back over is, I thought that even though we were dealing with the California fires in Q1, and that did make Q1 obviously not as exciting of a quarter, it wasn't as clear to see the continuation of all the improvements that we've been seeing in the quarters. One thing that was really, really bullish despite that, well, first of all, we already knew that was going to happen. But second of all, they were extremely successful at scaling. They started for the first time Q1, car grew faster than their other policies. So we saw the very first sign that car is actually going to be driving this next leg of growth, with the first ever quarter in Q1 where car was growing faster than the rest of their product books. So I think that was a really exciting sign. And because of that single sign, I was actually expecting, Lemonade might do really well from this Q1, even though the loss ratio didn't look that good because of the California fires, because the community knows how important car is, I thought that that single statistic was going to make people like start to get more confident that, you know, car is going to scale, and is going to drive this next stage of growth, and is going to be driving average policy, average premium per customers up, and et cetera.
Yeah, 100%. And if anybody in the audience wants to speak, you can request, or if you have a question, or if you want to talk about Lemonade, you're a Lemonade bull, or you know, a bear even, if you and you want to, like, you know, feel free. I'll just say, yeah, I agree with everything you're saying. The one thing I will say is, you know, the macro now, you know, these are just like little things. This is not focused on the business. This is just why maybe the stock doesn't move as much. You got interest rates going up. That hurts companies, smaller companies that aren't profitable. Like, I wouldn't let that dissuade you from investing, but I'm just saying these are some things that kind of hold sometimes these companies. I think, you know, and I think you've mentioned this, once you see, you know, rates come down and things of that nature, you'll see companies like Lemonade, and it doesn't have any tariff risk other than, you know, a little bit of basically, you know, the car parts, but the management talked about that and said it was, you know, going to be very minimal and very, you know, they could handle that very easily. So, but yeah, I think, you know, Jake, when you get on a roll, you know, you get on a roll. I love it. Like you're expressing everything that I think in my head. And like I said, I think the main thing with Lemonade is just to keep executing. What do you think about, and let me just throw this out at you. Do you think if the stock did have a big run, and we're not there yet, but like say it did have a big run, it was like 100, do you think the company should just keep executing, do the synthetic agents, now that they're having more cash, grow the business that way? Or would you be in favor of a share where they raise money through shares to get more money to grow even faster at a higher valuation? Or are you more in the camp of no, like I don't want to dilute, I just want to keep growing and let's keep going off of this base? Do you have any thoughts on that?
Yeah, I mean, I trust management a lot. So like they've let me just say, like management has blown my mind a couple times in the past by really diving into the mathematics of maximizing profit. And it's like they were talking about how the fact that they're targeting, like that they're having 70% loss ratios doesn't mean that they couldn't have lower than that, if they wanted to, but being able to accurately price risk means that you can hit the loss ratio you want, not necessarily that you're going to go to the lowest possible loss ratio. Why? Well, because if your loss ratios are a bit higher, it means your premiums are more competitive. It means you can take market share faster. So like then weighing that math between, okay, getting the most profit out of the current customers versus getting a little bit less profit per customer, but having way more total customers and just taking more market share, like they're going deep into these sort of mathematical calculations. So I will be happy if the stock, you know, if the stock's above 100 and they tell us, hey, we're just going to keep growing top line at 30% a year. We're just going to keep this going. We don't really feel like there's a need, or it would be advantageous to us to raise. If that's their takeaway, and I'm sure they've run through like hundreds of scenarios by the time they tell us anything, then I'll be happy with it. At the same time, if they tell us, hey, we're gonna raise, if we raise another $1 billion, like we can accelerate the top line growth rate from 30% to 45% or whatever it ends up being. It's like they have executed so well for so many years that I am going to first try to understand their logic, and as long as it makes sense to me, like I'm going to be fine with it. If that makes sense, like I'm
100%.
okay with a little bit of dilution for faster growth.
Yeah, this is on my head. I think this is like I'm going to ask you, Jake, this question because I'm interested. This is the number one when I do Lemonade posts and things of that nature. The number one pushback, and they're not even super bearish, but the number one thing that I see from either retail or just people in general, the knock on Lemonade is because either they're, you know, Tesla fans or whatever. Once we go autonomous, then car insurance won't be needed. So A, I want to get your reaction to that, why that won't hinder Lemonade in any meaningful way, if that's the way you feel. And do you feel management has spoken about this concisely? And if they have, can you articulate for me what they have said on this? Because I don't remember them saying too much on it. Maybe a little bit Daniel's talked about it. So I would like to get your view and then maybe what management has said on it regarding this specific issue of autonomous vehicles and that disrupting the car insurance market.
Yeah, so I think like the very first thing that just needs to be said so that it's so super obvious is that management is 100% aware of the autonomous revolution that's taking place before our eyes. Trust me, they are like an AI first company that is literally trying to automate their whole company. So they understand the cutting edge of autonomy, and they have expressed in earnings calls before that they are very excited actually about the changes that are happening, because they feel like, because they don't have the same innovator's dilemma of the current incumbents, that they're going to be able to pivot much faster when things become obvious, when it becomes obvious like who's going to be liable, who's going to be paying the insurance. Because one thing we know for certain is you're still going to need insurance for these very expensive vehicles. It's not like insurance is going away. It's just the liable party might change, the customer might change, and all of that. And Lemonade has said very clearly that they are ready to pivot, as like they are going to be making sure that they're there to soak up that market share, however it ends up looking in the future. So beyond that, no, they actually haven't shared many concrete plans, but that makes sense to me because we don't really know how it's going to look, right? Like Ajit, who's in charge of Geico at the last Berkshire Hathaway shareholder meeting, he got asked the same question, and he was like, "Yeah, it's pretty clear that autonomous cars will probably crash less." But if you look at like Waymos and stuff with LiDAR and all of that, like when they crash, it's going to be more expensive. So Ajit was saying it's like, you're obviously still going to need insurance. And I agree. Like maybe you don't need the crash insurance after humans on public roads is a banned thing of the past, but I don't know if that will happen in my entire lifetime, right? So you're still going to need insurance for crashes as long as you have humans on public roads. And Ajit is saying even if there are fewer crashes, if repairing LiDAR and stuff like Waymos is more expensive, it's like the premiums might not even drop at all. So there's just a lot of speculation right now and not much real understanding of how things are going to be. And I just trust Daniel and Chai. I just really do. And I think that their argument about not having the same innovators' dilemmas as the incumbents is going to allow them to pivot quicker. And then the other thing is too, you have to keep in mind, because Lemonade's not a monoline insurer, like right now, if cars went away, like all of a sudden cars didn't exist and car insurance was no longer an industry at all, it's like I'm still confident Lemonade would be able to get to $100 billion market cap. It's like their current premium, like the current revenue that they're taking in, it would not drop that much. Yeah. Now, looking forward, if as they continue to scale car will start to become a bigger and bigger percentage of their entire premium book. But yeah, I'm not worried about car insurance going away overall. And then if you want to chat for a second, I want to look, because I did a whole write-up actually on why I think that Lemonade Insurance is actually going to win out in an autonomous future and may even be able to outcompete things like Tesla insurance. So let me try.
Yeah, and Jake, I don't know if you're familiar. You probably are. You can pin anything you want to pin as like a comment at the top of the space. You can do that. One of your tweets or and people can go look at that. So you can pin it at the top. But anyway, yeah, while you do that, I agree with you. I think the notion that we're not going to have, humans driving anytime in my lifetime is crazy. Like it's going to take many, many decades to roll out everyone having an autonomous vehicle or to service, the whole United States. Like that is going to take a long time. So and there's going to be a lot of humans that they're going to want to drive their own car. And like you said, as long as the humans are driving, they might bang into the autonomous vehicle, and the autonomous vehicle then will need to be fixed. So it will need to be insured at some level, and maybe Lemonade can get into some type of an agreement with some operator that's doing it where they're their insurance company. So I mean, there's so many ways this could play out. There's so many ways. So it is hard to speculate, but I think when you're investing,
okay,
you got to look
I
at
did
over
find this.
yeah, like a 2-year time frame and 3-year time frame. And in that time frame, I don't think car premiums are going down much, and we're still going to have 99 percent plus of regular people driving regular cars. So that I think is it. That is going to be a certainty. So yeah, go ahead, Jake.
Yeah, for sure. And then the other thing that I don't think people are thinking about, which I don't think it's in my write-up either, so I'll just mention it before I dive into this, is that with autonomy, traveling by car is going to become more convenient, which I think is going to actually increase the amount of road traffic and is going to also increase the utilization of all autonomous cars. So today, a person might drive a car like a maximum of 1 or 2 hours a day on average, probably even a lot less than that, 15 minutes. And an autonomous car is going to be driving much more of its lifespan. So even if like the chance of crashing per mile drops, the total chance of crashing might actually go up because you're just driving so many more miles, which might even push up rates. Also, in the future that Elon is proposing, people are still going to own cars. Like he's talking about how you buy a Tesla, and there's divergence in the Tesla community about how long Tesla's going to keep on selling cars. But as far as everything that Elon has said, people are still going to be able to buy Teslas and then put them into the autonomous taxi network, which means like I have 2 Model Ys personally. I will be deploying them in the autonomous taxi network, and I can also have them insured by Lemonade while they're driving autonomously as an autonomous taxi. So already I am certain that Lemonade has some foothold in the autonomous future, besides the fact that, like you said, there's going to be many, many human drivers, I think, for our entire lifetime, just because people enjoy it. So this is the little write-up I did. So autonomous car liability is definitely going to be complex to resolve, over the next decade. But insurance is going to remain crucial no matter what, because liable parties, it doesn't matter if it's the owner, the software developer, the manufacturer, it doesn't matter how that changes. They're still going to need coverage. So accidents will decrease as autonomous cars dominate, but humans, they're not going to be banned from public roads, as we've been mentioning, as some will always prefer to drive themselves, at least in this generation. I think in future generations, if you've never driven a car, you're not going to know like what you're missing. You're not going to know if you enjoy it. So I think in future generations, eventually it probably will be illegal for a human to drive on a public road. It's just going to be for the sake of saving lives. That's going to be probably how it is in a couple hundred years. I don't know the timeline, but I don't think it will happen in our generation. Plus, like I just mentioned, Lemonade can insure autonomous cars still. So let's talk about Lemonade versus Tesla, because I think that this makes a lot of people a little bit uncertain about investing in Lemonade, because I know that Lemonade is actually very popular within the Tesla community. So let's compare Tesla insurance to Lemonade insurance a bit. So Elon has not been prioritizing insurance, first of all. So you have to keep that in mind. Even if you think, and I do really love Elon, even if you think he's one of the most genius people in the world that no one can really compete with business-wise, Elon's not focused on insurance. I think one of the main reasons why Tesla even launched insurance in the first place was because other insurance companies were making Teslas far more expensive by super overcharging for insurance. So Tesla had to enter the insurance market in order to price much lower, to force all the other insurance coveragers, like all the other insurance companies, to actually offer fair insurance premiums for Teslas, to just drive down the price of buying and owning a Tesla. So just for their core business, Tesla had to get into insurance in the first place to force the market to be competitive. So when driving risk, and then the other reason is like obviously Elon sees the big advantage that Tesla can have in pricing risk because they have all of the car telematics status. So I think that car telematics in a Tesla is the one place where Tesla would actually have even better telematics, even better data to price risk even more accurately than Lemonade, is Tesla insurance in a Tesla. That is the only single company, only single time that I think there is any company with an advantage over Lemonade, is pricing the risk of a Tesla driver in a Tesla. But when driving risk becomes uniform among autonomous Teslas, right? Because autonomous Teslas probably across the whole fleet, every single one of them is going to have the same chance of crashing because it's all the same drivers, it's all the same AI. So Tesla's higher operating expenses is going to eventually make it hard to match Lemonade's prices without subsidizing losses or becoming equally automated. So Tesla is actually removing their own advantage over Lemonade when they make everything autonomous, because now the driving risk is uniform across every single autonomous car, if that makes sense. So then the expense ratio of your company matters a lot more. And right now, Lemonade is far more automated than Tesla. So let's get into this a bit more. Unless do you have any questions, or are you good for me to just keep ranting here?
No, you're good, Jake. Go ahead.
Okay, so it's important to remember that big companies also are not guaranteed, success outside their core focus. So I know just like Hims, for example, like Hims has sold off multiple times in the past when it was announced that Lemonade was gonna, or not Lemonade, Amazon was gonna get into online pharmaceutical sales, like that sort of thing. But every single time, Amazon kind of failed to compete with Hims. So it's just important to remember that big companies, even though they're big and successful, it doesn't mean they're going to succeed in every single thing that they try. So I think Tesla would actually need a leader like Shai Wininger and a strong engineering team to build a fully automated insurance platform. Elon's biggest superpower is attracting talent. That is true. But if he's not focused on insurance and he's not like actively trying to attract talent for insurance, the superpower has to be used to work. So Tesla's insurance, is only going to be as good as its team. And I am sure that the Tesla insurance team is high class. But for Lemonade, winning insurance is literally everything. And Lemonade's plan of achieving this, through building this infinitely scalable autonomous organization, it's an unmatched plan. Tesla does not have this plan. They've never communicated this sort of plan. So let's talk about 4 specific ways where I think that Lemonade outperforms Tesla insurance. And you have to remember that, Tesla is one of my 3 holdings. I own Lemonade, Hims, and Tesla. So I'm very bullish on Tesla. So the first way that Lemonade outperforms is that they offer instant claims payouts. Anyone in the Lemonade community is going to know this, but Tesla doesn't. Tesla doesn't offer instant claims payouts. I currently have Tesla insurance, just so you know, for my Model Ys. And like this just shows the power of Lemonade's AI in areas like fraud prediction. And more importantly, it shows Lemonade's culture. Like this is the whole aligning incentives thing. Like Lemonade wants to pay out as fast as possible because their main focus isn't paying out as little as possible. So the fact that Tesla's payouts take weeks, despite the fact that Tesla literally has vehicle crash telematics data, so they know you crashed, they know it's not a fraudulent claim, they still take weeks to pay out. It kind of just shows me that I don't think Tesla's insurance team is really competing with Lemonade. I don't think they are. They're not on the same level. They're not competing on the same level. They're not competing with the same level of customer care. So that's advantage 1 for Lemonade. Advantage 2 for Lemonade is that Lemonade's AI customer support, via Maya or the audio call AI that they've integrated, which can literally make changes to your poll. Like it can literally access everything. It's actually helpful. It's far above Tesla's current level of AI customer support via text and audio. So Tesla did actually launch an AI phone agent last month, which is a good step, but it's not a good AI agent. I just want to read one review that I saw because I was doing research on this because obviously I care about this a lot. I think about Lemonade all the time. I'm obsessed. So obviously that makes me obsessed about their competitors as well. I have, the majority of my money in this. I really care about being right. So this is one of the reviews. Quote, it fucking, sorry, mind my language. Sorry if there's any kids. It effing sucks. I was able to scream at it and get me in touch with a human being after 3 tries of passing her basic security checks. I immediately knew I was talking to an AI. So that's like the current sentiment for Tesla's AI. Now this is going to improve. Like I think Tesla's obviously going to innovate much faster than incumbents. Tesla doesn't have to fail at insurance for Lemonade to win. I think Tesla will succeed as well. And I think it's cool that they're trying to do some of these AI, text to speech and stuff integrations. But right now they're super far behind the experience that Lemonade offers. Okay, number 3. The third advantage that Lemonade has over Tesla insurance right now is that Lemonade's single platform AI hive mind, including AI underwriting and risk prediction, it's trained on a growing data flywheel, and it creates a moat, I think, similar to Tesla's driving data moat that Tesla is using to train full self-driving. So one of my big bull cases for Tesla was that no one else is collecting millions of miles of 360-degree camera footage in order to train an AI to drive well. Like no other company has that, so no other company is going to be able to train an AI to drive as well as Tesla. That's a massive moat. Well, no other company currently has an insurance data flywheel. If you look at Geico, Ajit said that there's over 600 different independent systems. These are systems that cannot communicate with each other because they're using different software stacks. They're just, it would be very, very difficult to try and hook up an AI that could actually learn from all the data coming into Geico. Like not even Palantir is going to be able to help Geico do this, and Geico's not even trying to do it yet. Ajit said that they're currently like staying in a state of readiness regarding AI. They haven't tried to implement any AI stuff, and I kind of understand. It would be super freaking hard for them to do that. They have no software talent. You know, most insurance companies, actually, I think all of the incumbent insurance companies just buy off-the-shelf software. So they have no talent to do anything like this. So Lemonade is creating a moat that is going to be growing as they continue getting more and more customers. And it is creating a data flywheel that Lemonade's going to be able to use to train their AI super intelligence to be the best insurance super, like it'll be completely about insurance. It'll only be smart about insurance, but it's going to be smarter at insurance than any person. And it's going to be incredible at running an insurance company. And if no one else is collecting this data, then no one else is going to be able to train an AI with the data. Same way that if no one else is collecting the driving miles, no one else is going to be able to train a driving AI. So Elon has not attempted anything like this in insurance. He's busy. You know, Tesla vehicle telematics and driving scores to personally priced insurance is an advantage over legacy, but it's not the same thing as being in the early stages of training an AI insurance super intelligence. Two completely different focuses and in goals here. Okay, so then 4, the last one. There could be others, but this was the last one that I thought of where Lemonade Insurance has an advantage over Tesla Insurance, and that's Lemonade's give back program. It fixes the conflict of interest that toxifies the whole insured-insurer relationship. And as much as Elon does, I think about things fundamentally, about things that he really cares about. I mean, he was the first person ever to teach me that I needed to think about things from a fundamental level, from a first principles basis. Like Elon's famous for that, but I don't think he's thought about insurance, you know, from a first principles basis before. I don't think it's important enough when there's so many things that he's working on for it to ever have been worth him, you know, spending weeks thinking about insurance from a fundamental level like Shai and Daniel did while they were like coming up with their idea, where they're just like putting hundreds of these ideas on a whiteboard. If you read the book, Making of Lemonade, you learn a little bit about this. But like Shai and Daniel have obsessed about thinking about insurance from a first principles basis. So because of that, they realized one of the most toxic things about insurance, which is the conflict of interest between the insured and the insurer, and they created the give back program. So this is a major advantage for Lemonade, because this is an issue that must be solved if you have any hope of creating an actually loved insurance company. So unless Tesla did something like this, which Tesla's not a B Corp, and I don't think they will do something like this. I am guaranteed, I know for certain that no legacy insurer is ever going to do anything like this. Their shareholders won't let them. This is a massive moat for Lemonade. And just so you know, the give back is only if loss ratios are under 40%. So it's not like this is actually going to hurt Lemonade in any way, but creating that 40% minimum, it just creates a level of trust that you could never have with any other insurance company, because you know every single dollar they deny from you, they keep. So the bottom line here is that, you know, if Elon made insurance his number one focus, you know, maybe Lemonade would sweat, but he hasn't. And it's Shai and Daniel's entire mission. So I'm going to bet on Shai and Daniel every time here.
No, great stuff, Jake, and super good stuff. I love your detail. You go into it with passion and, you know, great analysis. While you were talking, I was just jotting down some things that I think, you know, are important. Now, they're not as specific as yours. I'm more of a broad stroke kind of guy, but like this is some advantages for Lemonade. And I think you shouldn't the audience or investors should not understate these. So you were talking about big insurance, and you mentioned some good things why they can't. And Daniel said this, like, even if they could, even if they had the software people to do it, they wouldn't, because it would take them, 2 board meetings, 3 years to decide to do it, because it would disrupt their whole business. They would have to get rid of their whole business model, all their agents, and that would be very disruptive, and it would take a very long time to break apart these companies that have been built over 50, 60, 100 years. So that's step one. Step two, the Lemonade app. Everyone says, "Oh, it's just an app. It's a cool app." I play around with the app. If you're out there, if you're in the audience, go play around the app. I used to play around with the app. Now, Lemonade Insurance, it's not everywhere, but you can still play with the app. It is so beautiful. It's delightful. I smile when I use it, and I'm literally like putting in insurance stuff. So it's like, it's a great experience. It's very user friendly. It's so easy to do. And, it's not as easy to put those things together. Shy has worked on that, the touch points and how it acts. And if you watch an investor day, how it reacts. Oh, I want to do my engagement ring. I want to insure it. Oh, well, congratulations. Great. That's very exciting. Here, like, they make it so easy, and you're so excited to buy insurance. They put you in a happy mood. These things are understated for the long term. These little things add up in the long term. And then I'll also say what really, really got me excited about Lemonade and the Lemonade Insurance business. Their touch points, and Daniel talked about this a million times, but the advantage the AI has, and they continue every day to get all these touch points. When does the customer get the insurance? Is it at midnight? Is it 1 PM? Are they going through the website? Are they going through the app? Over time, as they continue to get customer after customer, they are going to see a pattern of, if you do it like this is a great customer. If you get a touch point through at this time, and they get this insurance, man, the loss ratio is this. And they talked about Investor Day, how great and already their predictive models are, from actual predictive to actual over like a year time or a 2-year time. So as that flywheel keeps going, and then they get more customers and more data points, and they get all that information of when, how, why, all those things, they'll be able to get, when that comes through again, they'll be able to price it way better than some insurance company that does not know you from Adam or Eve, and they're just looking at your income or your race or your gender to give you some generic quote, or your age, and which is not efficient, and it's not good for the customer. So over time, the best customers will go to Lemonade, and the worst customers will not, and they'll stick with their legacy, because they're actually getting a better deal, because legacy is not really distinguishing from the great drivers to the poor drivers, where Lemonade will, and they will give you a better claim when after a year they notice that your driving is so good from their telematics. So these are all the little advantages that Lemonade have that other legacy insurance do not have, and that's what has me really excited about the business going forward.
Yeah, I think that's really good. I think we had a Kartik had another question. And by the way, if anyone else has any questions or comments, feel free to request a speaker. We'd love to hear from you. But go ahead, Kartik.
So one thing I wanted to understand, if anyone has an idea that, okay, right, as of now, we know from last few quarter, the car is available in 3 to 4 states. Like, what is stopping them to move it to more state? Is it like they just want to first check the risk reward, or is it like the regulatory state, each state has their own regulation? So that is the, so any insight on that?
Yeah, no, I think that's a fair question. You go ahead and answer it, Christian.
No, go ahead, Jake. I just want to make sure you understood it. Go ahead.
Yeah, no. So I think that Lemonade has made it pretty clear that their first focus, before trying to expand it and grow it as fast as possible and get as many customers on as possible, has just been driving loss ratios down. So since they acquired Metro Mile, which was several years ago now, they actually kind of weren't growing the book at all. They were just trying to gather the data. The loss ratios were really bad, what they acquired from Metro Mile. So they've just been focused on driving those loss ratios down, and you have seen it. Like if you actually look at the earnings, every single quarter, the loss ratios have been getting driven down for cars. So I think they're just finally getting to the loss ratios where they're getting comfortable that this next cohort can be expanded. So I think it's only a matter of time before we do start to see, more of those states unlock. I think they're going to focus on unlocking states in order of where they have like the most cross-sell opportunity. So that kind of explains the order in state unlocks that they're going for. But yeah, insurance in the US is very complicated, and the fact that it's state by state jurisdictions of regulations does make things a little bit slow. And there's different strategies that you could do for unlocking car. Like Root, they're only a car insurance company, right? So the CEO in one of the earnings calls I was listening to, one of the Root earnings calls, an analyst asked him about this, like, how quickly are you going to be expanding to these states? Like, why are you going in this order? And he was like, well, we had this whole plan laid out, but then we just decided let's apply to every single state because we have no idea how long each of the applications is going to take. So there's different strategies that you can go for it. And I think that Lemonade is just trying to stay slightly ahead. Their focus has been loss ratios, but now as loss ratios are coming down, their focus is shifting to growth, which is why in Q1 we did see car grow faster than the rest of their book for the very first time. So I think it's going to be an exciting period ahead, and way more states are going to unlock over the coming months and years. Did that answer your question?
Yes, thank you.
Yeah, of course.
Yeah, that's the one thing I'm really
comment?
looking forward to. I love when they announce a new state. It just it shows me that they're getting more confident with their program. So Colorado is important. I know on the call they talked about several more states this year. So I'm definitely looking for at least 2 or 3 more states this year to come online. That'll be super, super bullish. And yeah, I mean, it's just a great company. It's like back with Tesla in 2019. I watched all the Elon videos. I would obsess about it and go through it, and you could see it. The bears had it wrong. Like you could see the units were going to grow. Forget everything else. Just the car business about to explode. And I see kind of same thing here. I love Daniel. All the interviews he's done with retail. He's super super knowledgeable guy, super smart, super well spoken. Shy less. I know. Jake has shared, and I saw that one too. He doesn't do many interviews, but the couple he's done, he's kind of a shy guy. He really smart guy, really really gets the tech way over my head, but like he gets it so good. And he also was involved with Fiverr, if you remember, another successful company. So these are serial entrepreneurs too that like are really in it to win it, and they don't give up, and they're the real deal. So I think that's super important. If you do invest in a company, you got to know the management inside out. Tim Bixby, I love him. Maya Prasur, these are all quality people. I'm probably leaving some out. Even the one that did synthetic agents on Investor Day 2, the young gentleman, I forget his name, Jake, you probably know it. He did a great job explaining the synthetic agents and going through the financials. So yeah, I mean, I've just been super impressed with this company from day one. They've never, ever disappointed me with any type of presentation they've done, anything. I mean, here and there a little bit with the growth slowing down a little bit, it was a little bit, and the stock got hit from that. But other than that, they've been executing. And I think synthetic agents was the key for them to get this growth rate back up to 30%. And if they can grow at 30 or even more, like I think Daniel said, it's sometimes maybe 40% if they're really pushing it, is like that is not in the stock, right? Like no one believes that they can grow 30% like for the next 5 years top line. So, once they start to show that quarter after quarter, and the other big thing is they guide conservatively, and I think sometimes they get hit for that. But there's going to become one of these quarters when they keep getting car customers and that premium per customer goes up, which essentially the in-force premiums are going to go high really quick. I think you're going to see one of these quarters, they're going to say, we're going to up our guidance. I'm not saying for sure, but I'm saying I can envision one quarter in the not near distant future, in the next maybe 1, 2, 3, over the next year, where they come out and they say, sorry, we told you this, but cars going so well, now we're going to go, we're going to up it. And they've never really done that dramatically. And I think once that happens, that'll really show Wall Street that they're hitting on all cylinders. And I think that could be a big catalyst to the stock.
Definitely. Just going back to Shai, sorry for trying to break it and interrupt you. But have you seen? He has literally been architecting and tweeting at Sam and OpenAI, explaining to them how to create a self-learning AI. It's just like, what other insurance company employees is trying to like help OpenAI, get their AIs to be able to learn better and have better memory? It's like, you just see where Shai's head is, and you're like, wait, this is not a normal insurance company. Like they're doing something.
You're right, Jake, and not to break on you, you're right. I was reading it. I'm like, I don't even understand what he's saying. So I'm gonna invest in this guy. I have no clue. Like, yeah, he's talking like the Sam. I'm like, I have no idea what he's trying to say, but he knows his stuff. Like, I gotta be with this guy.
Yeah, no, it was super cool. Like he's explaining how you create these like memory states for AI so that as the AI lives multiple years, like it literally retains memories, but how like our brain, like we retain a lot of memories as humans, but our brain doesn't grab every single memory that we've ever had for every, like in order to like make any comment, for words to come out of our mouth. Like our brain somehow is able to just grab those memories that are relevant to the conversation or to the moment that we're in, and that gets pulled to the forefront. So yeah, he's explaining stuff in this and a lot of this technical jargon that does make it very confusing. But you just have like AI, like you put it in ChatGPT or have Grok explain it to you like you're 5, and it's really cool the type of stuff that he's talking about architecting. Like it's literally like he's coming up with similar sorts of ideas that I'm seeing from Andrej Karpathy, who was the head of Tesla's full self-driving program, ex OpenAI employee as well. And it's like, yeah, we have this AI genius building a fully autonomous insurance company, and it's being priced like it's not innovative. It has no growth potential. It's being shorted like they have real bankruptcy chances, and they just hit free cash flow positive, and all of the metrics are going in the right direction. I made this tweet. I think this is one really interesting way to think about Lemonade as a company, which just puts it in a completely different perspective. But I wrote, a new AI startup recently surpassed 1 million paying subscribers faster than Netflix and Spotify. So first of all, this is a very fast growing AI startup. This is getting paying subscribers faster than some of the most successful companies in the world. Like I think Netflix is worth $500 billion, and Lemonade hit 1 million paying subscribers faster than them. They're building a new species of company, an infinitely scalable autonomous organization. Now that sounds like a buzzword. Let's break that down. What does it mean to have an infinitely scalable autonomous organization? It means that once AI knows how to do all of the tasks, you can add as many customers onto the platform as you want, and it doesn't add any additional human work or human expenses. Like this is a mind-blowing concept that people would have thought of as like a super sci-fi, never going to be possible thing before 2020. Yet Lemonade started building it in 2015. That's interesting. It's maybe like Shai has been on the cutting edge of AI before everyone else jumped in and is now an AI expert. So an infinitely scalable autonomous organization, like I am super bullish, and I don't even think I respect how profitable that means that Lemonade might get in the future. So they're building a digital subscription company operated by AI instead of humans, which means that it's immune to traditional scaling expenses. That means that all of the historical analysis about how to value something like this, it's thrown out the water. Yet, so then it's been public since 2020, and yeah, it's ignored by the market despite the fact that it's going for a TAM that's like north of $3 trillion because insurance is 8% of US GDP. So this is the company that we're looking at here. It has $1 billion in cash. It has $1 billion in annual subscriptions, or IFP, however you want to think about it. So $1 billion in cash, $1 billion in annual subscriptions. They became free cash flow positive in 2024, a year early. They're projecting a cruising altitude growth rate north of 30% going forward, and they're valued at 2.3 billion. I guess less today after the crash. So $1 billion in cash, $1 billion in subscriptions, valued at $2 billion. That's far below, just so you know, far below the 25.8x median revenue multiple. So 25.8 times, almost 26 times the revenue multiple for the average AI company in 2025, according to Aventis Advisors. So they're trading 2 times their annual subscriptions. And the average for an AI company in 2025 is 25 times. So it's like it just doesn't make sense. So, and then also it has proven leadership, right? With both co-founders, Daniel and Shai, who are currently CEO and CTO, having previous $1 billion exits. So it's like, it seems like the sort of AI unicorn that is like a generational ignored opportunity right now. And when you put it in that sort of a context, it just doesn't make sense. Like the valuation just doesn't make any sense. So I don't know. Do you think that's a effective way to think about it?
Yeah, no, yeah, you stole the words from my mouth. It's like, yeah, it doesn't make sense to me, other than like the only thing I could say is just because it's, not profitable yet, that it just gets, ignored by certain people that maybe can't invest in a not profitable company. And like you said, a lot of the retail's into Nvidia and Tesla, and nobody's looking. Nobody's looking at this company. But yeah, the way you said it, like it makes me like the opportunity is immense. So I think the key thing is, if you believe in the story, is patience. Like you have to be so patient, because you could see all these other stocks rocketing, all this other stuff, all the excitement, and your stock is kind of just sitting there. We had a little bit of excitement at the end of 24 when we went kind of from 18 to about 52 real quick, but since that, and when we first IPO'd, there was a lot of excitement. But like since then, if you go look at a chart, a 5-year chart, it did that, and now it's just been basically a flat line for like almost 5 years now, 4 or 5 years, with a little bumps up here and there, but it's basically gone nowhere. So it's like the key to investing is buy low, sell high. So this would be low. If you believe in the company and they're going to execute over the next few years, this would be low. Could it go lower? Of course. That's why you need like some cash on hand to buy low if you want to be a main position for a long term. But like this is investing, and the patience required if you're going to do a long term investment, because the market could stay very irrational for very long. So when I'm just talking about something that I trade and I invest, but like Lemonade's one of these things where I don't want to trade it as much because of the opportunity is so great. It's one of those, I think, generational companies that can do this crazy 10, 20, 30, 40, 50x or more. So you want to be in those, and you want to kind of buy the weakness rather than trade for a quick profit, because you never know one of those days where it gets going, because it is 30% short. And no one can really tell, exactly when it's going to take off. It's probably going to take some type of catalyst, such as an earnings report that really wakes a lot of people up and gets the thing going. But other than that, I think Jake did a great job explaining valuation there. It's such a compelling valuation where so many things are so overvalued. And here you got this great innovative company that has great innovative leadership, and it's trading at an amazing valuation. So that's the holy grail of investing, right? Finding these great companies before anybody notices them. So the due diligence is required, and then the conviction to hold and add on weakness is required. But yeah, Jake put it great.
Yeah, I think another way to think about valuation is you can do like a look through price to earnings ratio. So like long term, I think that it's very reasonable and actually quite conservative, very conservative, to say that Lemonade might have like a 15% net profit margin. So if you put a 15% net profit margin on their current in-force premium just above $1 billion, which would be a look through earnings, like this is what I'm paying for the company, kind of based off of their long-term expected net profit margin, you're literally paying less than 14 times earnings right now for a company that's growing over, well, it's going to be cruising out to 30% a year revenue growth. So like people are talking, screaming and crying about how Google is so undervalued at 16 PE. And it's like you have a company that's growing way faster than Google, trading even cheaper, but it's like it's small, it's ignored. Like no one knows about Lemonade right now. Like I feel like if more people knew about Lemonade, like sure they would be happy to buy it, but how many people actually know the story? And like that's the crazy thing is right now, while it's under the water, it's like the only like most of the institutions that see it just view it as an insurance company. But like as soon as it triples, as soon as it gets close to that 180 previous all-time high, it's like then all the eyeballs are going to turn on it. Then the retail like community is going to be like, oh my gosh, look at this revolutionary AI company. And then everyone's going to be wanting to buy it. And we're going to see way more trading volume, at $160 than we would ever dream to see at $30. Because like right now we have like, I think it's like $30 to $60 million only of daily trading volume. It's like if you get any eyes on this stock, it's like the new equilibrium price is going to be crazy. And then you throw on the fact that it's one of the most shorted stocks in the market, and you throw on that short covering. And that's why it's like, I know for a fact there will be days in the future where Lemonade's up more than 20%. It's like, I don't know what days those will be, but I know that those days are ahead. And I don't think they're actually that far away, because like Lemonade is like very clearly on the cusp of becoming a certain story. So I would encourage you guys, like, don't be too greedy about it. Cause I've personally had this inclination. I'm like, Hims is on a run. Like Hims has momentum, even though I think that Lemonade has better returns over the next 20 years. If I keep more of my money in Hims, cause Lemonade's not moving, it's like, maybe I can double my money and then buy twice as much Lemonade, those are the types of things that you're thinking. But it's like, don't get too greedy on Lemonade. Like don't wait too long, because this is like the kind of stock that when it actually starts running, like it's just going to run away from you so fast. So personally, like because we have EBITDA profitability right ahead of us, like we're not that many quarters away, I think that we maybe have like 16 months max to accumulate, maybe less, maybe a lot less. But eventually, like the secret's out. And as soon as the secret's out, like the stock's tripled. The only way that does not happen is if all of the data, all of the trend lines that we've been seeing completely flip the other way, which is, it's not going to happen. It's like insurance is such a stable business. These trends are going to continue that have been like going for multiple years now. So positive free cash flow was achieved in 2024. By next year, Lemonade is going to be spitting out EBITDA profitable quarters in a true free cash flow explosion. And like, this isn't just me saying this. It's like the Lemonade leadership got up on stage and told us that we're about to have a free cash flow explosion. Like, I think they might have literally said those exact same words. So this is when everyone's going to start talking about it. Like this is when your feed, I know I'm in your feed right now saying Lemonade's going to 100x, but this is when your whole feed, everyone in your feed is going to be saying Lemonade is 100x. And after it triples, maybe it still is 100x, maybe it's still more, but if it's 100x, then that means it's a 300x today, but before all the hype starts. So, yeah, I just think that it's dangerous if you sleep on this too much, because when it starts running, it's just going to get away from you. It's on the cusp of certainty, and when a story becomes certain, it does not continue to be priced the same way that it was being priced when it wasn't certain. So yeah.
No, 100%. Jake, you got to make it your mission to get as many followers as you can, and you got to do a space as much as you can to get the word out.
Yeah, no, I mean, I think it would be doing a.
You're doing a public service.
For sure. Yeah. Sorry, my little lines weren't coming through, so I wasn't sure if my mic was working. But yeah, I know it would be a public service. I definitely, like, there's no reason for me not to do it, right? I mean, if I'm thinking about Lemonade every day, all day, and writing about Lemonade every day, all day, I might as
So
well
let me
be
ask you,
talking
Jake.
about
So I've seen some of your stuff. You seem like very, and I get it. I've had those moments too, like, and still do. But I think you might even be a little bit more of a degree than me. Literally, is Lemonade occupying your entire day? Like your thoughts, I know you have a lot invested in it. But like, is it like every day? Like, I know you do other, but like, tell me how much Lemonade, the company, is on your mind on a typical day. Just fun anecdotes.
It has free rent, for sure. And I would probably give it, like, the last couple of weeks, over 50%, which is kind of insane to think about. Um,
Yeah, and then when did you get? I
yeah.
think you said you started. I may have this wrong. You can clarify. You started really loving the company after Investor Day 2, or did you know the company before and had
Yes.
investment, or was it
So I
was it after the Investor Day, or kind of a little bit of both?
so I was first introduced to Lemonade by the really really great Tesla investor. Um, oh, what's his name? He has a YouTube channel. His wife is
Dave
dealing
Lee.
with yeah, Dave Lee. His wife is dealing with cancer right now, unfortunately, so he has not been making content. But the very first time I ever heard about Lemonade was shortly after the IPO, because I was all in Tesla back then. And I watched all of Dave Lee's content, and he said in an interview that he thought that Lemonade was potentially a bigger opportunity than Tesla. And I was like, what? Wait, Dave Lee said this? So this is like way back before the stock ran up to 180. And I think that was actually part of the catalyst that caused it to run up. But I never touched it then. I never touched it. I was interested. I definitely watched some of Daniel's interviews back then. I think Dave Lee even had a couple interviews with Lemonade management. So I was very familiar with them. I watched Investor Day 2022. But to be completely honest, back then, like, the story was not guaranteed. Like, it was a lot more risky in 2022 than it is today. It's been so de-risked compared to 2022. So I loved the 2022 Investor Day though. I really did. Like, when Daniel was explaining like that, like how like the AI brain was lighting up, the AI brain that was Lemonade in that 2022 Investor Day, and talking about like I wish I could show you guys the visuals right now, but like he would show like Maya's brain chemistry and how when Maya would have to answer a question, like all of the other AI models that it would communicate with and all of the different like data sets that it could reach out to and stuff. It was just really cool. But at that point, even though it was a good idea, it was like a far from certain idea. They were losing a lot of money back then. They were very far from free cash flow profitability. And, back then they had far fewer subscribers, far fewer customers. They had far less premiums, and the stock was way more expensive as well. Like, literally the price was much higher. So back then when I saw it, I thought it was interesting, but I never wanted to touch it. It never tempted me to like sell some Tesla into Lemonade back then. However, back looking last year in 2024, I was thinking about Lemonade, just popped in my head, and I was like, I wonder how that company has been doing. I should relook at it, because I know that a lot of those IPOs are just like really underpriced. So I went and looked, and Lemonade was like trading around the $15 range that it has been for a couple of years. And I saw that there was a new Investor Day, and I watched it, and I was like, oh my gosh, like, they actually, like, every single promise they made in the 2022 Investor Day, I don't care what it was about, whether growth rates, whether loss ratios, like amount of automation, like they beat all of those guidelines that they put out. And because of that, like, not only did it greatly increase my confidence in their ability to project, but also just where they were was now just not risky. Like, the fact that they were becoming free cash flow positive, the fact that they've already put up an EBITDA profitable quarter if you subtract growth spend. I was like, wait, this business is inherently profitable, and you could see like on a chart, you could see how as revenue increased, profitability was increasing because fixed costs were fixed costs, right? So that makes the profit margin of every incremental dollar of revenue insane. And it was very similar to 2019 when I had known about Tesla. My younger brothers for many years before that actually worked doing water cooling stuff at Tesla Fremont in California. So I knew about Tesla, but it wasn't until I saw the battery costs declines and how Tesla was about to flip to profitability. I'm like, oh my gosh, I need to all in on this company. It's priced for bankruptcy and it's about to become super profitable. So this is literally the same thing repeating now for Lemonade, where you can see it's a different reason. It's not battery costs declining, which is the biggest single cost of building an EV leading to profitability. It's fixed cost, which is making each incremental dollar of revenue far more profitable, which is going to lead to insane profitability. But same concept. You have a company that's super shorted, priced like it's not profitable when it clearly is going to be pumping out cash looking forward. And it just seems like we're on a cusp similar for Lemonade right now, similar to where we were for Tesla in 2019. So yeah, after that, I started to get really bullish on Lemonade, but I only made a small investment, which it was a small percentage of my portfolio. But I started to buy it. And it obviously ran up a ton, which really sucked. But as soon as it pulled back down, baby, I have almost $3 million of Lemonade now. I'm almost all in on Lemonade. It's like I went from 20,000 to 2 million with Tesla, and now I think I will be going from 3 million to I think potentially $1 billion with Lemonade. So,
That's crazy.
yeah, yeah,
No, that's a great guess. I know you're heavily. I mean,
If it's
that's a
okay,
massive investment. Go ahead, Kartik. Yeah, go ahead.
yeah, it's fine if you cannot share. Do you, like, for example, I can say that Lemonade is like 10% of my portfolio. Do you, are you able to share how many percentage of your portfolio is Lemonade?
yeah. It's over 70% now of my portfolio is Lemonade.
Wow, so you really have a great conviction. Yeah.
Yeah, pretty much. I have a very strong conviction. I mean, now you guys need to do your own research, right? You need to obviously you need to understand the things that I understand and see them the same way, and it needs to make sense in your brain, and you need to entirely own your own investment decisions. Do not invest because of someone else's conviction. However, if I hear people with a ton of conviction about something, obviously that interests me. It makes me want to go look into it and see if I come to similar conclusions. But yeah, you guys definitely need to do the research and come to the conclusions yourself. But there's a big Lemonade community. There's a lot of people that have started to come to these conclusions. I think most of the community isn't bullish enough yet, but that's fine. That's fine. I have no problem with that. I am just really excited, and I don't need it to happen now. It's like, I think when you know that you're on the cusp of something insanely exciting, the anticipation is almost as fun as when it actually happens. Like knowing that you're kind of in on a secret that other people haven't heard of yet. Yeah, it's fun. And that's why it's like I have no problem if I have to wait 5 years for this Lemonade story to play out. I cannot imagine why that would happen. I think that would be insane. But I think I would be fine with that. Okay, we have someone else comment who wants to come speak. Ken, or Inform. Hello. Informational arts.
Yeah.
Yes.
Yeah. So I was just wondering, usually when a company like a insurance company becomes hugely profitable, there's some stigma around that. And I think that's what they're trying to get around with the give back program and stuff like that. Do you think they will be allowed to become that profitable?
Yeah, it's so if you look at the actual statements that Lemonade releases, the give back program. So okay, so this is how it works. So when you sign up for insurance on Lemonade, you're prompted to pick from a pre-selected list of charities for excess premiums to be paid out to if you have a low loss ratio. So then each one of those charities becomes a cohort. So every single person that picked that charity now enters that cohort. And then at the end of each year, if the loss ratio for the cohort is under 40%, then anything up to 40% gets paid out to the charity. So it's such a low level. Like, so just so you know, like most most insurance companies' loss ratios are more, in the 70, sometimes 80% range. So it can drop to the 60s for sure. But having payouts under 40%, go to charities, it doesn't impact Lemonade's ability to print money in any way whatsoever. Like kind of the way I'm thinking about it, I think that long term, like they're targeting 70% loss ratios right now, just so you know what they're targeting, because they want, when your loss ratios are a little bit higher, it means your premiums are lower. So that means that their current logic is, let's focus on less profit per customer now so that we can steal more market share, so that we can keep growing. Because we're pricing lower, so that makes it easier to just steal a bunch of customers. 15% can grow a multi-billion-dollar business, as Geico proved to us. So that's their current focus. Long term, I think that maybe that loss ratio, like once they have a mature market share, maybe they target a little bit lower, like 65% or something. But then the other side of it is where Lemonade gets really exciting, because traditional insurers today, you have the loss ratio, but then you also have the operating cost ratio. So like together they create the combined ratio. So a traditional insurer's operating cost is oftentimes north of 20%. And this includes stuff like insurance agents, which Lemonade doesn't have, taking like long-term 15, 20% of the premium just forever. Like the operating cost for traditional insurance companies is huge. The amount of that premium that can't become profit. So if Lemonade drops that to like a 10% expense ratio, or even a 15% expense ratio, like just picture this. You have 65% loss ratio and 15% expense ratio. So that's an 80% combined ratio. That's a 20% profit margin. Bam, Lemonade is twice as profitable as the next most profitable insurer already, which I think is Progressive, has like 11% net profit margins right now. And that's ignoring the float. That's ignoring any profit from reinvesting the float. So it seems quite obvious that, well, first of all, the give back program doesn't affect that at all, because that's looking at a 40% loss ratio. So like in that sort of scenario, if Lemonade, had a 35% loss ratio, gave 5% to charities, so that became a 40% loss ratio, and then had the 15% expense ratio, you have a 55% combined ratio, so you have a 45% profit margin. Like that's unheard of. That's unheard of in insurance. Like that, you're talking about if Lemonade had the same market share as Progressive and that sort of profitability, they're priced in like the trillions of dollars, not the hundreds of billions of dollars, the multiple trillions of dollars.
But if their profit margins are that high, you not think there will be some pressure from the public for them to lower the cost of their policies?
Yeah, no, for sure. So that's why my long-term target for Lemonade is just 15% net profit margins. So that's assuming a 70% loss ratio, which is their current target, and then a 15% expense ratio. Gives them a 15% net profit margin, because you have a 85% combined ratio. And so that's my long-term target. And if you look at how expensive Lemonade is now, if you put a 15% profit margin on their $1 billion in premium, you're buying it for like 13 times look-through earnings, which is insane for a company that's growing. Like their growth rate, their annual percentage growth rate is 3 times higher than their PE ratio. Peter Lynch says if you find a company with a growth rate that is twice as high as its PE ratio, it's super undervalued. And we have a company that it's a look-through PE ratio, but that I think is trading 3 times cheaper on a PE ratio to annual revenue growth percentage. Does that make sense?
Yeah. All right. Thank you.
Yeah, for sure. No, thank you for the questions. I really appreciate people coming up and talking, because then I actually like understand kind of where your guys' minds are and stuff. Do you have any other questions, or does anyone else have questions?
No, that was great, Jake. So I think we've been going at it for a little bit. We'll do more of these, but I think we'll wrap it up now. Jake, we're a wealth of information. I mean, you know this stuff back to front. Super passionate about it. So anybody here, follow Jake. If you want to know more about Lemonade, Jake is constantly on it. So great stuff. Thanks, Jake, for joining me, and I hope everybody had enjoyed the chat. I did. Nice to meet you too, Jake.
Yeah, great meeting you, Christian. Great meeting
All right.
you.
Talk to you later.